Hey guys, Frank here with the National Real Estate Post. I just want to get this to you guys real quick. This just in, Remen Wholesale is doing a webinar today. It's a live streaming video webinar on how to get millennials to buy into renovation loans. It could be a really cool tool to have in your tool shed or your toolbox. Click this banner over on your right. Had to drop that in before we get started. And so now, on with the show. Let's get Barry Habib in here. Barry, how are you this morning?
I'm great. How about you, buddy?
I'm doing good, man. Always good to see your smiley face.
It's good to see you too.
I want to get you on, but before we get kicked into some information that you've got for us, which I think is going to be very interesting for everybody, I just want to bring up some thoughts on some previous things that you had told us about. You've been talking about seeing the stock market maybe cool off a little bit here. You've been saying it's kind of due for that. You've seen a little bit of cooling here, but
a little bit. Hasn't happened the way that we thought it would happen, but it has cooled off a little bit. It hasn't gotten any higher, but it's come down, not significantly. We thought maybe there was a little more weakness that we could see with some disappointing earnings, which indeed we got. Seems like, thanks to the drug of zero interest rate policy and the Fed, the stock market's been very resilient. Look, where else are you going to put your money? I'll tell you where you could put it, in real estate.
Yeah, right. Well, speaking of that, that's a great segue into what we wanted to talk about that. So there's been a lot of talk out there in the media about, bubbles and everything cooling off and housing weakening, you know what I mean? Give us your thoughts on that.
Well, one of the things they point to slower existing home sales. That's simply a function of lower inventory. And I don't have to tell anybody who's watching the show. They all know that one of the issues out there is low inventory. But what the media doesn't understand is that low inventory means fewer transactions, which is going to show up in slower existing home sales. Not that it's been slow, it's actually been good, but it hasn't been very robust, and the media takes that to be a negative. The thing though is that when you have lower inventory and you have good, strong demand like you have, this is very supportive of home pricing increasing. So home prices increasing, and that's what a home buyer wants. If you're a home buyer, what do you want? Do you want to see more housing starts or more home sales, or do you want to see the value of your home doing better and increasing? I think we all know the answer to that question. So the housing market remains very healthy on a lot of fronts. Demographically, millennials, the birth rates are really strong. Inventory is low. Just today, we got numbers out of CoreLogic. Foreclosures are down 23% from last year. That's shrinking inventory even further. The seriously delinquent loans are now at a level where they're at 3.1%. That's a drop from even the great numbers we had previous to this. So tighter underwriting guidelines are tough, but the quality of loans is really good. Plus, people have built up equity. They want to make the payments. This is a really good, healthy housing market that we're seeing right now, and it's going to continue. I talk to people from all over the country. We get data. This is going to continue. The opportunities right now. And Frank, we have to convey this, because think about the mindset of a buyer. So you go to buy a home, inventory is light, you're probably going to settle for something because you don't have all these choices, and now you got to pay full price. And when you pay full price, maybe there's another bid and you have to come over full price. So you know what? Buyers are a little bit kind of fed up, and what we really need to do is keep them focused on the opportunity long term.
Yeah.
Somebody might say, well, what if it appreciates 5% a year? So 5% a year can change your whole wealth profile over 7 or 8 or 9 years. And we have to keep them focused on that and illustrate and articulate those facts to them. And that'll keep the buyer's mindset in and really help the realtor.
Yeah, you're right. It's an educational piece on our part to let them know that, you might be getting a little bidding war right here, but it's actually working out to your benefit down the road in the long run. So
yes,
that needs to be our continued message going forward. And I hope everybody gets that and everybody's confident to continue to push that message out, in their marketing and in their conversations and all of that. So thanks for that info. And then you were mentioning something earlier when we kind of did a little pre-interview here about people were talking about a possible recession and even lower rates. What the heck?
Okay, so they go hand in hand. So let's think about the possibility of a recession. So there's always another recession. This is a cyclical economy, so it's going to go in waves. So are we going to see a recession? 100% we are. The question is when. So we have GDP that's pretty weak. It's pretty vulnerable right now. We know the manufacturing is already in a recession. We see earnings declining on the S&P 500 for 7 quarters in a row. So is there a recession coming? Probably. When you take a look at what's been definitive of a recession, one of the good indicators is seeing that 10-year treasury dip beneath the 2-year treasury. Now there's some room there, But I think that if we look at the trend, and we have that on our MBS highway, you could see it's getting closer and closer and closer. Another thing people point to is say, well, unemployment rates are very low. Here's the interesting thing, and I brought this up in one of my morning videos on MBS Highway, is recessions don't occur when unemployment rates are high. Recessions happen after you kind of bottom out in the unemployment rate. And where we are now may be close to a bottom in the rate of unemployment. And if we see that, a recession could be sooner than we think. Maybe that's why nobody wants a job as president, because they'll probably see a bear market in stocks and a recession during the next presidential term. So if we do get a recession, and we will, but if we do in the next few years, what does that mean? It means, number one, where's a great place to be? Right where you are in the mortgage and real estate industry, because historically, believe it or not, real estate does well. Forget the last recession, because that was led by a housing bubble. But all the recessions prior to that saw housing hold up very, very nicely. Think about early 2000s. Think about how well real estate did. But combine that with interest rates typically moving much lower. So yes, does it support housing? Of course, but it also could be a refinance opportunity. So think about this now. If you see in the next 3 years, 4 years, a recession coming, why would you want to pay a bunch of points on your mortgage today? Or why wouldn't you at least think about an adjustable rate mortgage, which could save you a lot of money, and you'll probably be in a position to refinance? Because you could see interest rates 0.5%, 0.75%. I know it sounds crazy, lower than where they are today. Yeah. But if you think it's crazy, look at Europe. Look at our 10-year Treasury is 1.75. The German Bund is 0.1. They're negative rates in Asia. So could we see lower rates? We could.
Golly, that is such an interesting thought there. And I think we'll just leave that with everyone to digest that today's show. But before we go, and I want to thank you for being here. It's always great information. Let's remind everybody about MBS Highway. They can go there. Is it a 2-week trial?
Sign up for a 2-week trial. Give us a call.
Yeah.
We'll walk you through. It's really affordable too. It's really inexpensive, but we give you so much.
Yeah, it's a great product, and you stay in touch with everybody every single day. But wow, okay, so a couple of great messages for everybody on the team here to get out. Housing strong, and my goodness, you might actually see lower rates in the future, when this, recession shows its head, right? So
I think that's a very reasonable thought process. Look, we all know that nothing in life is guaranteed. There are things that can occur, things can happen. We know that, of course. So this is not saying that this is 100% definitely going to happen, but I think that there's a sound thought process there that would at least lead us to believe that these are real probabilities, and we should at least forecast for those when we advise our customers.
Yeah, and this is, we're talking this could happen years from now, a few years from now, so it's not like
sooner than we think. Sooner than we think.
Okay. All right. Well, that's awesome stuff, Barry. So great to have you on the show. You guys, leave us your comments down below, forward, share, subscribe in the upper right-hand corner. We'll catch you guys later here at the National Real Estate Post. Thanks, Barry.
I like it. Thank you.